Welcome to our presentation on valuation today. This is just an introduction, but valuation is critically important. If you're a franchisee about to sell your business, nothing's more important than getting the pricing right. Because if you don't, it's likely to sit on the shelf for a very long time. And if you're a buyer, you want to have an informed comparison between opportunities, and so using a structured method will help you get there. Members at franchisesmartmarket.com have access to our valuation tool and in-depth instruction. Both go far beyond our presentation today and walks you through a step-by-step process that just about anybody can do, and you can run different scenarios as often as you'd like. It's a valuable resource, and I hope you take advantage of it. Thanks. My guest today is Roben Hunter, and she's a valuation specialist, both a CPA and an attorney. She's going to help us dispel some myths and really provide just kind of an ABC's basic introduction to the thought process behind valuation.
I'm a partner at Beckerman, Grafstrom & Mayer. It's an accounting firm in Minneapolis. My principal jobs are in tax, business valuations, and litigation support. On the side, I have a little law firm all by myself. I'm a lawyer and a CPA. In the law firm, I do primarily transactional type work, really servicing the entrepreneur.
If you're a franchisee getting ready to sell your business, the very first step is to get all your financial records together in one spot, organized and ready to provide to a qualified buyer in one fell swoop. Nothing kills a deal faster than trickling out information over time. Let's listen to Roben Hunter describe what she might be looking for in the course of evaluation, which is the very first thing buyers will be looking for too.
I typically look for 5 years of tax returns and financial statements. And by financial statements, I mean balance sheets, profit and loss statement, and a cash flow statement.
Before our next segment, I want to begin by defining EBITDA. EBITDA is an acronym that stands for Earnings Before Interest, Taxes, Depreciation, and Amortization. It's the first step in measuring cash flow. There are other adjustments to make too to establish cash flow, such as capital improvements the business is going to need. Let's take a listen to what Roben has to say and how she would work with that.
And what you do is you basically take this last year's worth of revenue and you do something called normalize it. And what that means is that you take out all of the strange things that normally aren't in that business. Things like if there's a litigation that typically isn't there from year to year. You want to just get a streamline of the operations. Owners are being overcompensated, you take that overcompensation out. Or if they're not being compensated at all because of the times or whatever, then you add normal compensation, reasonable compensation in. Would diminish the value, but you normalize that revenue stream. From a buyer's perspective, you want to understand what the potential of that business is going to be.
As a buyer or a seller, you may come across a business in which you've got multiple business units under one tax return or under one legal entity. As you'll hear from Roben, she'll advise both parties to consult with your accountant.
Well, you'd have to work with your accountant to try and split that up and make an appropriate analysis of that in particular business. Okay. You want to keep that as separate as you possibly can because normally you don't want to sell these in bulk.
Any business that's been around for a while will likely have seen variations in their revenues up and down over the course of time. As you'll hear from Roben, the important part is to understand why.
Well, I think again it depends on the uniqueness of that business and why those fluctuations happened. If it was an economic type thing or if this business in particular was undergoing some kind of crisis or had one client that was just booming and all of a sudden, they had all this increased revenue for a year and a half and then it dissipated. We just don't know. So it really depends on the circumstances of why those fluctuations occurred.
A little earlier in the program we discussed EBITDA, an acronym that stands for Earnings Before Interest, Taxes, Depreciation, and Amortization. It's the first step in establishing cash flow. When we think about EBITDA multiples, if you've heard about that, what we're talking about there is multiplying cash flow by a certain number of years that we call an investment time horizon. That time frame might be 2 to 5 years depending on the business. It's important not just to consider EBITDA, but all the adjustments that go into it as well. So adjusted EBITDA would account for things like capital improvements.
Well, I think EBITDA multiples are a good starting point. I think that they're a way of checking your calculation of what you believe the value to be and saying, does it make sense? Are we within a certain range? There are other ways of valuing a business, doing a discounted cash flow analysis, doing a capitalization of earnings analysis.
Any business over the course of time was going to need a capital improvements at some point. Some part of that cash flow needs to be adjusted back. The buyer is going to get the majority of the benefit of that improvement. At franchisesmartmarket.com, we address this more in depth using our valuation tool and the in-depth instruction you'll find there. But for now, let's listen to what Roben has to say about capital improvements.
I would definitely deduct that from your value as of today, because it is something that you know that you're going to be doing in the future. I would deduct what you believe your fixed asset improvements are going to be. It's going to affect your revenue stream as an additional expense, so it'll diminish your discretionary earnings.
One of the most problematic rules of thumb out there is a multiple of annual sales. I hear about it coming back to me all the time. Businesses in our industry often sell for 1.5 times revenue. The problem with that rule of thumb,
well, again, the uniqueness of the business is missing from that approach. The uniqueness of the geography where the business is located. $100,000 in Des Moines, Iowa is different than $100,000 in New York City. You can buy more in Des Moines, Iowa than you can in New York City with it. Your potential is different in an audience in Des Moines, Iowa than it is with an audience of future customers in New York City. Your geography is different. The whole chemistry of the business is different. It's a completely different place. So having those same multiples would seem kind of problematic for me. The other thing is that you would have the same before and after economic crises, before and after 9/11. Do you think that a hotel on September 1st was the same as a hotel on September 15th? I don't think so, or even the September 15th of the following year, but yet the revenue multiples that you're referring to, they didn't change.
I started my career in franchising by buying a distressed business in 1997 for about 25% of what it would have cost to build it new. We tripled revenues in the first year and a half, and in fact that spawned the growth of 11 more stores in just 5 years. But distressed businesses are not for everybody.
That is a dilemma of all time, isn't it? It truly is. And what you need to do is you need to look at those value drivers and do your research. See if you think that you can turn that into something that will be financially secure for you, and the buyer should be able to pay it off within the time frame that they want to. They want to make sure that the seller is whole. If there's some owner financing or something like that, potentially make sure that the business is paid off during X number of years so you can go on and enjoy the rest of your business without having that debt hanging over your head.
So on the softer side, if you're a seller, what are some things that you can do to spruce it up just a little bit? Low cost items. Maybe there's new paint on a wall. There's some other things that have just gotten really stale over time.
Well, you need to try and look at it from a buyer's perspective. You need to put yourself into the shoes of the buyer and say, what type of business would I want to be purchasing? Happy employees. We want to make sure that it's a well-maintained business, that the equipment is up to date, that it's clean, that it's safe. So there are many things like that you can look at ahead of time and try and find where your value drivers are in your business, and try and accentuate those things for those potential buyers out there.
People ask all the time, when's the right time of year to sell? And the answer might surprise you. You've had a history there, so now's the time to sell it in advance of the busy season so the buyer can get excited about that. That's how it'll get financed. Think of your business and the annual cycles it goes through.
Well, keep in mind that every business is unique, and some businesses are quite cyclical. A Dairy Queen sells better right before the summer. You know, it's not going to sell great in December.
Right.
You know, so some of these businesses are cyclical. You just you kind of need to know your individual business.
I want to thank Roben Hunter for joining us today and giving a brief introduction about business valuation and how to price a business appropriately. I encourage you to become a member at franchisesmartmarket.com. The boardroom is a virtual meeting space where you'll move the transaction forward, but it also includes your team. And your team could include your banker, your attorney, your accountant, or others that are all involved in the transaction so that no one skips a beat. Following a step-by-step process and get to the end successfully. Members at franchisesmartmarket.com have access to our valuation tool and in-depth instruction and walks you through a step-by-step process that just about anybody can do, and you can run different scenarios as often as you'd like. And if you've got a story that you think is a great fit for Franchise Smart Market, drop me a line. Thanks.